Invest in real estate instead of the Wellington fund? Interesting. Let's go to the show notes, the comment section. So this is from my video on if I had $1,000,000, I'd invest in Wellington fund. And my man Paul writes in, I've been investing in the stock market for 40 years. All right, so Paul's older, probably a little bit older than me actually. I'm 51. I got out 10 years ago. All right, so it's 2021. That means he gets out in 2011. The first thing he should run is and bought 4 rental properties, paid cash. Each property is paying over 10% rent, and the property value has gone up 200 to 300%. Best thing I could have done. Good luck with bonds and any Wellington funds. All right, so Paul's, you can tell he's been a little bit snarky there, but okay. And I said, what does 10% rent mean? 10% of initial purchase price? And we're going to come back to that here just a little bit. Look, man, I know what's happening here. We get this all the time on this channel, like, oh, I'm not doing that. You should do that. Look, I get that. And I got no qualm with the comment, and I'm not here to bash Paul, not in the least. Good for you. Good for you. But the idea of like that best thing I could have done, i.e. it's the best thing you should have done. Look at me, I did it and you didn't. And I challenge that because I think Paul's missing something here significantly. So let's go into this. And again, this is not to say, look, if he's freaking living large, I'm fine with that. But I'm going to show you something that I think is getting missed here. And I have a sneaky suspicion he doesn't recognize that. It's always good to say, I did the right move. I didn't do a bad move. And I don't think Paul did a bad move. I'm just saying, why does it have to be either or? Why are these things mutually exclusive? Yeah. All right, so let's go into this. We're going to look at Portfolio Visualizer. And look, man, I've been in this business a long time. I know exactly what happened with old Paul here. All right, so Paul, he's been investing for 40 years. I put him back to 1990. All right, 1980. 1980. So he'd been investing in 1980. He had great returns in the 2 decades from 80 to 90. And then in 2000, it just fell and nothing happened. And so here's what I guarantee is what happened. In 2000, he had $1 million. I'm just using, I don't know, he had $1 million. I'm assuming he did. And we're going to have him in the S&P 500. He's been making bank. And then all of a sudden, for the next 11 years, that $1 million grew to 1.056 million. And with all of his downsides in here too. So his compounded annual growth rate was 0.46%. I guarantee Paul was sitting there after 2011 said, man, retirement's coming down the pike. I can't afford this anymore. I'm not making money. There's significant downside risk. I got back to even. I'm cashing out and buying rental real estate. I guarantee that's what happened. I can't tell you how many people I went through the same thing when I was in my working years. Be like, man, I'm not making any money. This is bullcrap, blah, blah, blah. And they're getting out. Even worse, a lot of them got out and bought gold. And not even gold, the actual coinage or the bullion, but they got gold mutual funds. Oh, horrible. All right. Good. So Paul says he's taking his $1 million out. All right. So he's buying 4 rental properties. So he has $1 million. Let me put this up. There we go. And he's buying 4 rental properties. All right. So they are now worth $2.5 million. He said they grew from, each has grown between 200 to 300%. We'll split the difference to $2.5 million. So his rental property's done great from an aspect of price appreciation. He's also getting 10% rent. Well, I guarantee you it's 10% rent on the cost, not 10% rent on the value today. And the reason for that is because if he's getting 10% rent, that's $100,000 in rent. All right. On those 4 properties, which is $25,000 each. 25, 25, 25, 25. All right, so he's getting 10% on cost. That's not bad. I got no qualm with that. But $25,000 a month each is a little bit more than $2,000 a month rent, which actually makes sense. I know he's not getting 10% on value today because that'd be each would be paying about $5,000 a month in rent. That's just not happening. So each is paying about $2,083 a month in rent. Nothing wrong with that, man. Nothing wrong with that. But as we can see here, a couple things jump out at you. He's worth $2.5 million now. he's getting 100,000 in rent. So let's just say today we're going to erase all this, and we're going to say Paul is worth 2.5 million today, and he's getting $100,000 of income. All right, with me so far? All right. So what we're going to do is we're going to say let's go to Portfolio Visualizer, and we're going to use that compared to Wellington, because that's what I said. I said if I had $1 million, I'd invest in Wellington. And so we're going to say basically Paul, he, instead of doing the rental thing he did, he said, I'm just going to go to Wellington Fund. So 1.056 million is what we're going to use to our starting point. And is that $1 million? Yeah, 1.056 million. We're going to start in 2012 because Paul he capitulated in 2011, said, I got to get out of here. I got to do something else. And again, he's not like he made a bad move. He did fine. I just say to myself, well, the idea that his move is, the best thing since sliced bread. Well, no, it's not. So what are we going to do? We're going to take 5% a year off this 1.056 million, and that will give us 1.0 times 5%, $52,800. $52,800, and we're going to start in 2012. All right. We are going to adjust it for inflation. We're going to draw it annually, and we're going to reinvest dividends, and we're going to display income. That looks good. And again, we got to change this ticker to Wellington. WELLEX. There we go. Let's include year to date, I guess. All right, so let's see what we got here. You ready? Boink. So, does it give me? Yeah, it should give me that. All right, cool. So at the end of, how much income are we getting here? I want income. All right, so basically we started in 2012 with 48,000, went to 85, 87, 85, 63, 99, 133, 80. We're making 130 at the end of 2020. We're making $138,000 of income. All right, $138,000 of income. What's the account worth at the end of the time? Right now it's worth 2.02 million. All right, so let's dive into this a little bit. We're not even going to talk about the taxes that come with it, because what's going to happen with Paul is if he's rental income, I hope he's taking a lot of write-offs, so which was essentially could make his rental income even more tax efficient. But when he sells it, he's going to have to recapture those write-offs. So that's going to be a hit to him tax-wise in the future. So basically by taking write-offs and depreciation stuff, you're deferring taxes to a later date. That's just a fact. And nothing wrong with that. I got no qualm with that. And the Wellington would say it's outside of an IRA, because I said if I had $1 million, what would I do today? I don't even care. You can do ordinary income. You can do outside an IRA. If it's outside an IRA, a lot of that income will be qualified dividends and long-term capital gains. Will be more tax efficient. I'm not even comparing taxes. I think that's a wash essentially. But what I am going to say is we got $2 million compared to Paul's. Oops, I want to go here. We got $2 million compared to Paul's $2.5 million. To sell that $2 million is we sell it in a snap. Liquid. We don't have to do anything because we got a price point right now. For Paul to sell it, he has to go through either realtor or, he's got to do something. Selling a house is a freaking pain in the butt, man. Everybody knows that. So for Paul to sell it, now we don't have to deal with CDC moratorium on rents. We don't have to deal with changing toilets in the middle of the night. We don't have to deal with drunken friggin' meth heads who are friggin' running, baking meth in your kitchen, in your bathroom. And look, I'm sure his tenants are fine, but you know how it is. With rental real estate, every now and again, you're going to come across a crappy old tenant. We don't have to do with any of that. We don't have to do with putting various things in LLCs to protect our other assets. We don't have to put things in, we don't have to have umbrella policies, homeowners insurance, whole thing. We don't have to do any of that. So for all that hassle that we don't have, we're 400,000 to the poor, 500,000 to the poor. Again, assuming that he can sell those things just like that with without having to write off some stuff or pay back. But he can't. But still, we'll just say we're 500,000 to the poor, but we're 38,000 in terms of annual income to the richer, or 38%, and that's a Wellington fund. I mean, look, man, at the end of the day, you can't say one's better than the other. Is Wellington better than that? I would say, yeah. Why? Because it's less risky. It's not less risky. Rental is a tangible asset, yeah, but you still have 4 units. Each of those has issues when it comes to fire, uh, lawsuits. I mean, freaking MS-13 moving into your neighborhood. You know what I'm saying? All that stuff. Wellington has issues too in terms of 2007, 8, and 9. It fell 37%. What did real estate do? It fell too. Did it fall that much? Probably not, but we don't know. It depends on your location. The reason, where I'm going is, why does everything got to be mutually exclusive this way or that way? It's the weirdest thing. There's no such thing as mutually exclusive in retirement planning. You got to be nimble, man. You got to say, okay, but it's the weirdest thing is like, I did it this way. Every other way is wrong. This way is the way to go. No. I mean, so what's wrong with saying, look, man, I'm going to buy a real estate investment trust, a REIT, and I'm going to keep some in Wellington, and I have some cash, and I'll have some, maybe I'll even buy a rental property too. Maybe I'll buy a freaking place in, I don't know, Cocoa Beach, Florida, and I'll rent it out once, 6 months out of the year, and I'll live there the other 6 months out of the year. All kinds of different things to consider. Stop making everything so mutually exclusive, my friends. Nothing has to be. Stop. It's not Bible. This is not biblical stuff. All right? Just relax and recognize that things, A, change. B, there's more than one way to skin this retirement planning cat. For me, because I'm a lazy guy, I just want I want Vanguard to take care of it, or Schwab, or T. Rowe Price. I don't care. I'll pay them 25 to 35 basis points a year, and I'll be done with it. That's the way I like it. I like it simple. So I can go out in the garden. That's what I want to do. All right, we'll see you.